From the morning reading, the tides of March and the FOMC lift stocks on rising volume. The Qs have a new all-time closing high. Stocks and bonds rally on the Fed announcement, pullback in yields boost REITs and utilities, while banks lag. The dollar drops, boost gold. Stock indices react positively. Emerging markets lead foreign stock ETFs higher. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. It is currently 6:29 a.m. Mountain Time, and I'm recording this in preparation for the market day of March the 16th, 2017. Let's go ahead and bounce into the morning report. And at the time of this cut, all the U.S. indices, broad-based indices, were up, though not enormously. The S&P, the NASDAQ, and the Dow futures are all up about 0.25%. Russell futures are up about 0.4%. Crude oil is up about 0.8%. Euro was up about 0.2%. Long bonds down about a third. And gold up big, up over 2% in the overnight markets. In overseas action, you have China up about 0.8%, Hong Kong up big, up over 2%, Japan just above scratch, Germany and the United Kingdom are also up pretty big, up almost 1%. In macroeconomic reports for today of note for the United States, you have building permits, Philly Fed manufacturing, the weekly unemployment claims, housing starts, JOLTS job openings, and the nat gas storage report. So a long slate of reports for today. And looking forward to tomorrow, you have capacity utilization rate, industrial production, University of Michigan consumer sentiment reports. In terms of current volatility conditions, short-term VIX at a 10.76, skew very high. Very much way up in the warning area at a 147.2. In terms of IV percentiles, they continue to be extremely low. The S&P at a 6, the Russell a 7, the NASDAQ a 7, and the Dow at an 11. We did have standard deviation moves put in on all four of the indices yesterday for the first time in over a week worth of sessions. Obviously the Fed announcement was a big inflection point for the trading yesterday. In fact, let's go ahead and go to the charts. And you see here on the S&P, yesterday's definitely broke through that short-term set of doldrums, and all this green candle was pretty much put in related to the Fed announcement. Now, it did come off the highs, but still a very bullish move yesterday. Very much an example of the market liking what the Fed, and most of this happened when Janet Yellen was in her press conference and made some comments about the economy, and things really kind of accelerated at that point. Overnight, it did build on that, though we didn't get anything significantly higher than yesterday's high. We did certainly build on yesterday's close thus far. In the big scheme of things, we do not yet have a new all-time high in the S&P, though we came very close. I think somebody said it was like 18 points, 13 or 18, something like that. So certainly very high in the relative range, waiting for a new breakout. And indeed, you could look at these as bull flag breakouts, certainly a diagonal breakout. With yesterday's action here, we have the Dow futures, the same kind of action, big move yesterday and building on that with last night's overnight activity. Though on the Dow, not yet quite all-time highs either. Now, the NASDAQ was different. The NASDAQ did put in new all-time highs, And we continue to kind of run up this former channel line that was resistance, now turned relative support. But you had a new all-time high broken out yesterday, so it broke out over the horizontal resistance and then built on that with last night's coming in at 54.40 at one point in last night's action. So the NASDAQ is now leading all four of the indices in terms of relative strength. And then let's say the Russell here, big day on the Russell. It had been the weakest, and it definitely put in the strongest day yesterday, closing very much near the highs yesterday. And let's see here, in terms of the current Russell is also up now, so we are currently building on the ETF's close of yesterday. Okay, so now the Russell's got more room to go. I mean, even after this big move, they're not even halfway back through this range between these lows and the former highs. So things were very bullish in the short term yesterday, but also have more room to go. In terms of other markets, crude oil, of course, has been doing quite a bit of movement of late. The big breakdown, and then you look at these. We've got Doji. Look at these long wicks at the bottom. Classic turning pattern here, and seem to be at least in for a short-term relief bounce after all this negative action on crude oil. So bullish for the short term, though probably still bearish on the intermediate term in crude oil. Gold also putting in very large moves after much of the short-term weakness that had been coming in. We've come back in towards the cloud. And then in the Fed announcement and the dollar impact from that news really moved this market here with gold. And you see last night's activity building on that as well. And let's see, DXY. Here's our dollar. Nope, not going to work for us. We're not going to wait for that. Let's take a look at bonds. Bonds also had an inflection with yesterday, and it was one of those weird days where basically everything was up. Bonds were up, equities were up, gold was up, just about everything was up in all your major markets. And even those that normally should be going down when the equities are going up, they were all up. So very interesting kind of action yesterday, and obviously something will have to disconnect and return back to normal correlations at some point there. We'll continue to watch that. Volatility, as you would expect, continues to remain exceptionally low. At one point yesterday, we were down to a 10.6. Did close at 11.58, so we continue to operate, and right now playing at about 11.3. Will continue to operate well below a 12, so that by definition is very low volatility. Not much is being priced into the market in terms of fear, nor is there any expected move either to the upside or downside of significance going to be expected in these times of super low volatility. Okay, that's probably enough on the charts. Let's go ahead and go to the daily report. And we're still market phase 5, the break of diagonal support. Though if we build on today's action from yesterday afternoon, we could see this flip back up to market phase 4. So we'll have to watch and see that. We have not been given too much weight to the bearishness of this market phase 5 because it's been, in effect, a very weak market phase 5, and we've been flip-flopping back and forth between phase 5, the break of the diagonal support, and then also into market phase 4, which is a bullish phase in kind of an expansion patterns. It kind of describes that phase. So we take this as a minor warning right now. The market has been, up to the Fed announcement, a bit weak in the very shortest term time frames. And yet at the same time, the bears certainly have not been able to control anything to any significance. We've never had anything as of yet of a significant breakdown, even enough to be able to call it a pullback in anything perhaps other than the Russell. In terms of the three market timing signals, they're still bullish, though we have some signs of weakness. The first signal coming from IBD is in confirmed uptrend. That's bullish. GMI index still a 5 out of 6, and the buy signal there has been in place since 11:10. That's bullish. And then the third one, stock charts decision point scoreboard. We see these weakness coming in with these mixed signals on the short term. No change after yesterday's action quite yet. So we have that kind of in the thicket here. Intermediate term still bullish, long term still primarily bullish. So not a pretty stack here as of yet. And that kind of describes in effect our overall market and where we are in a bias to the bullish side, and yet not strongly bullish. We're looking for incremental new highs and periodic pullbacks, neither one of which of those are we expecting to be terribly strong legs. Position sizing opinion models, both models still coming in at 100%. Intermediate term market posture has improved with yesterday's action. We had a number of weak bears that have flipped back up into strong bulls, and if these go up over 80, with the S&P and the Dow, they will go back to exceptionally strong bull. The NASDAQ has stayed exceptionally strong bull throughout this short-term weakness that was espoused by the other indices. Now the Russell had been considerably weaker. It has flipped into a bullish stance at this point, back to weak bull. Now, all this is up against a falling sentiment line, so that is not supportive at this point, and this kind of gives us part of these mixed signals that we've been getting of late. That's part of the reason why we're not expecting any significantly large up moves at this point. In terms of the hedge warning status, we remain 0 plus, normal with some elevated conditions. In terms of the strategy opinions, option income strategies, we keep flipping back and forth. We were yesterday, the VIX was above the acceptable threshold, then by the end of the day was below the acceptable threshold once again. We keep flip-flopping back and forth above and below the 12. So obviously that means for novice traders to be a bit careful with respect to initiation of new positions for option income strategies, the premiums that you're bringing in, how close you probably are in terms of selling put spreads and so forth. You're probably closer, and you're probably struggling to get the valuations that you'd like to get from the premiums relative to the amount of risk that you're taking on. And we're also reflecting this in the covered calls, looking for a 1-to-1 ratio of out of the money and in the money strikes, and a 1-to-1 ratio of high beta and low beta positions. Relatively conservative continues to be the call for covered calls, with the expectation that much of the profit being made with this strategy right now is probably being made off the premium and selling these strikes, as opposed to capital appreciation of the underlying stock. Put selling, any kind of individual chart weakness is generally expected to be, in this kind of market, an opportunity. So certainly you're watching your watch list there. This is probably, unless conditions were to start to accelerate, this is probably the easiest strategy at this point, selling puts on your favorite watch list items. Certainly you want to have a position size in the scale that you are willing to own. In terms of specific areas of warning, this is really quiet. You have a serious warning here with skew. Obviously, a lot of people are buying put protection. That's running about a 14% probability of a 2 standard deviation move in the next 30 days is the warning that's coming from this indicator. And then from the trend-based area, you have improvement here. These were all 3 weak a couple sessions ago. We now have this weak warning market phase 5, and the new high, new low, kind of benign, a first day strong bull indicator on the intermediate term market posture. So kind of neutral overall in the trend-based area. In terms of the intermarket risk aversion indicators, also could be relatively neutral here, with 3 risk on, 2 risk off, and only a couple of these, really the first 2, with any kind of angle and separation going on. So pretty neutral in this area as well. Another area of relative neutrality would be in sentiment. Stocks, short and intermediate term, a bit elevated, but you see the fear and greed index is coming in at a 53 and is by definition neutral at that point. So not a lot of edge to the bulls or to the bears at this point. You see the big performance yesterday, overall market and the S&P up 0.86. Energy was a big winner. Real estates, utilities, telecom. So certainly three of the upper performers are kind of interest rate sensitive performers. So interesting how those areas responded to an actual interest rate increase by the Fed. Yields, of course, play a role in the relative value of some of these areas, though in the long term, rising interest rates are generally expected to be something of a detriment to some of these sectors. Bottom line is yesterday they took this as good news. Overall, the primary takeaway from the Fed announcement yesterday is that the economy is doing well and that there are some signs of potential improvement and rate of improvement going forward, though there was kind of an asterisk that the Fed was waiting to see what policy and policy changes came out of the new administration, what made it through the Congress, and would react to additional information as it becomes available. Now, yesterday, the only sector that was down was financials, though it was down, relatively mildly. And you see breadth was about half up, half down. So financials a bit of a hit. Though in the big scheme of things, this may, any kind of dip in financials is probably going to be seen as an opportunity. As you look forward in an expanding economy, and an economy in which interest rates continue to rise. These are all expected to be things that help the financials. So this is probably not something to be seriously concerned about with the financials. They're probably just going to reload and take off for another leg up sometime in the future. In terms of percent change, you can see a number of sectors that are certainly not as strong as others. Transportation, telecom, energy, financials, and retail, in relative terms and market postures across the different time frames, not doing quite as well or as consistent as, say, the consumer sectors. Healthcare, biotech has been improving of late. Utilities certainly has been doing very well of late. And in fact, we'll take a look here at utilities. Look at the performance here in utilities. Year to date, one of the stronger, though there's a number of strong ones on year to date. But look at the 3 month. Probably the third best performance. 1 month, the best performance. The 5 day, the best performance. And on the 1 day, one of the best performances. So utilities has been consistently strong as of late, and with the Fed announcement yesterday, built on that with yesterday's performance. So this is one of those, in quotes, safe haven kind of places in most market conditions, and to have this kind of performance is always of value to a balanced portfolio. So you might want to consider either the ETF under the utilities or some of the better performing utility components of that sector if you don't have any exposure to that in your portfolio. Okay, I think that's probably enough for today. Let's go ahead and wrap this thing up. And I'm going to scroll through a couple slides here. If you see something of interest, just hit the pause button. There's hyperlinks and so forth that take you to additional details. And disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. And we'll see you back here probably, unless the market's really active today, maybe tomorrow, but certainly on Monday, we'll be back with the next market preview video. Okay, good trading.